Hi, everyone. This is Josh Nelson, Keystone Financial Services. I hope you guys are doing great today. We're going to get started here in just a couple of minutes, right at 11:30, and I am excited to be able to deliver the halftime presentation. These are actually my two favorite presentations I give throughout the year, the forecast and the halftime. And the reason why is because what I find is that the biggest value that I can add as a financial advisor is to help people not have to worry about their money. And a big part of that I've noticed over the years is education. And we've done that for a number of years. We used to do that on the HP campus years and years ago. And I've done it in webinar format, and I've done it in face-to-face venues, kind of all over the place. But that's the one thing that I find why people come, why people want to listen, is because they don't have to worry about their money. They're walking around on a day-to-day basis and worried about the market and the economy and politics and everything and how that might impact their financial future and the stuff that they're able to do and the people that they're able to impact. So that's really what today is about, is trying to make sense of everything that's going on, take all the information that's out there, take what the experts are saying, and distill it into something that's actually useful. So again, we'll start here right at 11:30. I'll point out that there are a couple of features to GoToWebinar that you might want to use. First of all, the chat feature. You can certainly talk to me during the presentation using chat. If you can think of something that you want to ask, certainly use that. There's also a questions box, which you can use questions, and I'll go ahead and take those along the way. I'll make sure, to be expedient, I'll make sure that we get going and finish no later than 1 hour, probably a little bit faster than that, but I want to make sure that I'm respectful of people's time. So if I have to, I may end up holding those questions until the end and answering them at that time. And obviously, you can just email me as well if you've got it later, but sometimes in a group format, it can be more helpful. So I'm going to put myself on camera. Now we're right at 11:30. Glad that you're all here today. It's 11:30 on the mark, so I'm going to go ahead and get going. Josh Nelson, I'm a certified financial planner and a registered investment advisor representative. What that means basically is that I am a fiduciary. And fiduciary is kind of a fancy word, but what it means really is that I have a legal obligation to give you advice that's in your best interest if you're my client. And not every advisor is a fiduciary. In fact, actually a relatively small percentage of financial advisors are a CFP and are considered a fiduciary in the United States. So just because you're working with somebody doesn't mean that they have to follow those set of rules and those standards. So I would highly encourage you to look into that. If you're not working with us right now, ask those questions. Ask really what level of care they're expected to give to their clients, and also what am I getting for what am I paying for. That's very, very important whenever you're working with any kind of investment strategies or working with a financial advisor, financial planner, understanding how they're being compensated and understanding if there's any conflicts of interest that you would need to know about. Again, being a fiduciary, legal obligation that we have to give you advice that's in your best interest first ahead of our own. So with that being said, we'll go ahead and get started on Halftime 2018. Again, a couple of features, a chat feature and a questions feature, so please use those along the way for those of you who are dialing in live. I've noticed that we actually have more people that attend these on an after basis. In other words, that they watch the recorded version just because they couldn't make it to the actual time that we were doing this. So if you're dialing in later, that's great. Feel free to send us questions by email. Very easy. Just go to our website, www.keystonefinancial.org, or you can just email me at josh@keystonefinancial.org, and I'll get back to you as soon as I can. So that being said, I'm going to stop the webcam for right now and just put the slides on the screen. Again, any questions that come up along the way, please let me know. All right, so Halftime 2018. Again, this is a halftime report, which assumes that we had something before that, right? The January event that we did, the forecast event, we talked a lot about the economy and where it's going and shifts that are likely to happen, and some of those have come into fruition now. So it's always kind of fun to look back and see, how right, we were, the experts were on where things were going. I can tell you, I was at a conference in Idaho. Ben Bernanke was one of the keynote speakers. And, as far as economists, he's really one of the best, even though he's no longer the Fed chairman. He had his doctoral thesis was on the Great Depression and obviously had some very practical experience through the financial crisis, guiding us through an extremely tough time for the markets and the economy. So obviously somebody worth listening to. And obviously he gave some opinions. Now weave some of that into the presentation today. But at the end of the presentation, he said, but, at the end of the day, nobody knows. There's too many factors, even in today's world where we're able to use artificial intelligence and other things to try to make predictions. There's still too many factors. There's too many things that are unknown that could drastically change the trajectory of where things are going. So that being said, let's go ahead. Slide number 2 here is written by the lawyers. And so just understand that everything we're talking about is just my opinion. And obviously there's no guarantees or, anything that we know is going to happen. These are all just things that we think could happen. So today's agenda, as always, we talk about where we've been, where we are, and ultimately where we may be going. Clearly, there are certain factors that we can look at to predict where we might be going. I would say kind of macro stuff that we can look at that kind of tells us generally what season we're going into. If you think about the economic cycle and the market cycle, really both, think of them kind of like seasons in that you've got a period of time, the springtime, obviously, where things are just kind of shooting up and starting to grow after winter, right? So things are kind of being reborn. You get into the summertime, obviously, and things are cranking, things are growing, and things are getting really hot. And you get into the fall, and that's the harvest time, right? Which is always, a good time. We enjoy that. And certainly, we can enjoy the fruit of whatever came before that. And then, of course, wintertime, which is a very natural thing that happens. And clearly, we're not in winter right now. We might have some debate, as far as what season that we are in, but clearly we're not in winter. The economy globally and in the U.S. Is cranking along pretty good. Markets have been performing well. And really right now, it's more important than ever to take a look at, since things are good, what are some signs that things might be changing or signs that we could be going towards that winter. Of course, that's the big question, is when is winter going to come? I don't know how many of you are Game of Thrones fans, but, of course, that's the theme of the show all along through all the seasons is, winter is coming, winter is coming. And I can tell you from a market and an economic standpoint that winter is coming. The trick is when. When is that going to happen? How do we prepare for it? And then what do we do when it happens? That's not always a bad thing, because somebody that is prepared for it can actually take advantage during that time. So before we get going, we'll talk about a little bit of warm-up stuff. We always try to throw some fun in. And fake news, that was a big term over the past year. So we'll do a couple of questions here. We'll see if everybody can activate their creative side and their fun side, and maybe a little bit of brain power through this as well. But the first one here is, which is real news between these two? Pluto has been officially reclassified as a planet, or performing CPR, humming the Macarena, could help. And this one's kind of near and dear to my heart. I enjoy this question because I still think Pluto's a planet. My kids, I remember throughout elementary school, they kept saying, no, Dad, it's not a planet anymore. But it was when I grew up, so I still consider it a planet. But that being said, the Macarena, humming the Spanish dance song Macarena, could save lives. So remember that the next time you're performing CPR. Hopefully you don't have to do that, but think about that. Number 2, mushrooms might hold the secret to clean laundry, or Palestinians recognize Texas as part of Mexico. And the real news on this one actually is the mushrooms. So believe it or not, mushrooms, actually there's a Danish firm that's making laundry detergent using mushrooms as one of the ingredients. And they say that it's not only does it work, it actually works better than the chemical stuff, but it actually results in better environment and more energy efficient. And then we've got lawmakers seem confused about what Facebook does and how to fix it, or Charles Manson to be released on parole to Johnson County, Texas. And on that one, not surprisingly, politicians are confused, right? And so when Zuckerberg testified earlier this year, the bottom line is they didn't understand what Facebook did. They didn't understand how Facebook made money. And at the end of the day, really, it's an advertising company. So that's where they make their money, is by running ads. And then finally, stronger than steel, able to stop a speeding bullet, it's Superwood, or the Seattle Seahawks may be kicked out of the NFL for what they did in the locker room. And the answer on that one is wood, actually, that wood could be used to stop a bullet. It can be very hard. Some varieties, oak and maple, believe it or not. So let's get into where we've been. And it's pretty good. Like I said before, actually, the economy, especially in the U.S. right now, is cranking along pretty good. We'll talk about why that's important, not just what's happening, but why it's happening. And really, things have been going pretty well, both the market and the economy over the last span of time. So most people feel pretty good about the big factors. And I'll list those off because the four factors, if you were only able to pay attention to four things, these are the four that I pay attention to more than anything because I think they're the best sign that the economy and the market are in a healthy place or maybe not such in a healthy place. So if you think about that, number one is really looking at earnings. And if you think about the market, really the reason why the market exists, the reason why any company exists is to turn a profit. And profit also is translated to earnings and profit, same thing. But at the end of the day, that's why a company exists. And really, that's the only reason why any company has value is because of its earnings, its profits. And the investors, whether it's one person or millions of people that own a particular company, that's really the value that they're holding is they're holding the value of what that company is making, what their profits are. As far as stuff, the things and the stuff that company owns, the buildings, the equipment, things like that, not really worth very much for most companies compared to the real value if it's a very profitable company. So that's one. GDP, that's another one. Looking at gross domestic product is a measure of how fast the economy is growing. Number three is interest rates. And if they're low or they're high, right now we're actually relatively low, believe it or not, even though the Fed has raised rates a few times. The rates are actually fairly low historically. And then number four, inflation. And inflation meaning is not only the economy growing, but are prices going up? And are they going up at a is it overblown? In other words, where inflation is out of control, or is inflation low enough, or are we actually seeing deflation where prices are actually going down? You don't want deflation. That's a really bad environment to be in, and that's where we were back in the 20s and 30s. We actually had deflation, and the reason why that's so detrimental, even though you think, well, that would be good, right? Things get cheaper, but actually that's not a good thing if the overall economy is seeing that, because it means that if you hold on to your dollars, that means you could actually buy more tomorrow than you do today. And of course, that's really bad because that means that everybody, the government, businesses, individuals, there's a huge incentive not to spend money. And of course, that doesn't do well as far as fueling earnings or economic growth. So on the other hand, we don't want out of control inflation like we saw in the 70s and early 80s where prices are going up double digits and the money that we're thinking we can spend is not really worth a whole lot because prices are going up so fast that they're outstripping our ability to spend that money. So that's where the Federal Reserve comes in, and it's their job to make sure that we're controlling those two poles, making sure that we stay somewhere in the middle in a healthy place. So where have we been so far this year? A January rally, a correction in volatility. We had one of the best Januaries on record, and then that was followed by a correction in February. So interestingly enough, we did the forecast presentation in January, and I had talked about that we are due for a correction. It's been some time since we've seen any kind of a significant pullback in the market. But the good news about corrections is that most corrections, the vast majority of corrections, don't result in a bear market. In other words, the market drops, which technically is 10% or more, be considered a correction. A bear market is 20% or more, and very few corrections end up going down to a bear market. So the vast majority of the time, it's important just to hang on and stay diversified through those types of markets. We saw that in February. Why did that happen? Overall, you can see volatility ticked up earlier on in the year versus last year. Volatility was extremely low, and we got used to not losing money and not seeing the market bouncing around. And in 2018, obviously, that's changed, especially in the first quarter of the year. We saw a number of big swings downwards. Again, we actually technically went into a correction for a short period of time. And it's important to recognize that the volatility we're seeing now is actually more normal. This is more like average based off historical numbers. So It's one of those things, though, if you go on a flight, if you're flying to, say, Los Angeles, and it's completely smooth for the first 3/4 of the flight, and then all of a sudden it gets really turbulent, it feels really uncomfortable because you're not used to it. And of course, people who aren't used to flying at all, like people who maybe have been in cash and then they invest in the market, they figure out pretty quickly what volatility is and whether they're comfortable with it or not. So you can see historical average there in the middle, and again, 2018, as far as days that we would see the up or down 1% or more, 1% swing, it's a pretty big deal. You're looking at the Dow, for example, being at 26,000, and you see a 1% swing. 10% swing would be, obviously thousands of points, but even a 1% swing will be, say, a 250-point drop. Obviously, we've seen a number of those this year, but it is more normal. You can look back into the mid-2000s, in 2008, 2009, you did see a huge increase in volatility, and obviously we saw some huge swings on the downside. So important to recognize that the average that we're experiencing right now is normal. This is actually more like a normal market as opposed to the extremely low volatility of last year. And you could see other time periods there, 2004 to 2007, also very low volatility, 2011 to 2014, low volatility. So we've experienced this period of time where it's kind of not normal. In other words, we've just seen very low levels of turbulence. So overall, the reason for that is because the Fed, and we talked about this in January, is that the Fed really was shifting from this extremely easy money policy that we've experienced over the past 10 years, most of which they had interest rates at zero, which is about as accommodative as you can get. And then they did experiments with quantitative easing. We won't get into the weeds on that, but all kinds of experiments that they were doing basically to try to get the economy going and try to keep us from going into a deep recession. So the Fed basically has signaled that they are going to be increasing interest rates consistently, and it was a little bit of a tantrum. Basically, the market, had to adjust because we've gone from this really easy time with the Fed to this period where we know rates are going up to more normal levels. The interesting thing, though, is that if you look at where we are right now, historically, interest rates are actually higher than they are right now. So we still have room to go until we're even back up to what a normal average would be. And because the economy is taking off right now, the Fed actually feels okay with that. They feel like they really need to get us up to more normal levels, simply because we're seeing normal economic growth. And we'll see where we go in the quarters ahead if GDP growth continues to accelerate. But it is important to recognize that the Fed is keeping an eye on those things very closely. And again, that other side of things, inflation, they really don't want us to go into a high inflation environment, which can happen. It can happen, especially when you've got such a low unemployment rate. What ends up happening is that employers have to start paying more and providing more benefits, incentives to employees, which I think we all would agree, well, that's a great thing. But the companies and any kind of a business won't just take that as an expense. They're going to pass that on to their customers. And when their customers have to pay more, then that is what inflation is, right? Just a collection of goods and services that have gone up in price. And it's the Fed's job to try to keep that in check, where we're seeing price increases at a healthy level, but not at the point where it's hyperinflation and we can't even keep up, financially as individuals or businesses or the government with the cost increases that are being incurred. So we've also seen a big swing first half of the year as far as which sectors did well. You can see the S&P 500. This is as of June 30th, by the way. So we've seen actually a pretty good July and August. The market's seen some growth. But if you look at the S&P 500, midway through the year, you really didn't see much of any growth. S&P up 1.67%. And it highly depended on which sector you were in. You can see technology would have been the clear winner of all the sectors and consumer discretionary stocks. And then obviously some sectors like telecom that had a big sell-off. So that's one of the lessons, I think, of successful investing is to not put all your eggs in one basket, stay diversified, because you're probably not going to be able to guess on a year-to-year basis which sectors are going to do the best. Having all the sectors, obviously, you're just going to get a broad collection of sectors and stocks and what they end up doing. Your odds of being right and being able to time the market, I think increasingly are actually getting worse, not better. Day traders, that used to be around. I don't think there's as many day traders today as there used to be, but day traders used to try to time the market. And now that so much of the trading activity that happens is computerized, And in algorithms, it basically makes a short-term investor have a really, really hard time to catch those movements and be able to make money on it. In fact, usually they end up losing a lot of money on it and doing way worse than the person who just bought, diversified, and held on for a long period of time. So overall, again, first half of the year, these numbers look a little bit different right now here on August 23rd, but you can see year-to-date performance. The market in the U.S. here was pretty flat, both with real estate and stocks. Saw slight increases. Clearly, the losing investments this year would have been especially the international stocks and emerging markets had a sell-off. And there's a couple reasons for that. One of those is that there are inherent risks in emerging markets. They tend to be much more volatile. There's a lot less political stability in those markets. So you tend to see a lot more volatility both on the up and the downside. So it's not that we don't want to have any emerging markets or international stocks in people's portfolios, but typically because they are more volatile, we don't overweight those areas. We don't want to have massive amounts of international stocks unless people are really thrill seekers and are okay with a lot more volatility. So looking at this chart, though, you would think, well, that we should just throw the international stocks out. Let's not invest in those things. But I can tell you that there's two reasons why you want to hold a diversified collection of investments. We call that asset allocation. That's kind of a fancy financial advisor term for having your money in different areas. So if you kind of oversimplify what you should do with your money, which according to Ben Bernanke and Ray Dalio and a lot of huge financial experts say that one of the top decisions, one of the most important decisions that any investor makes is how much money do they put in their security bucket. That would be the types of investments that wouldn't see as much volatility or might even have guarantees with them. And then the other bucket is the growth bucket. That's the things that would tend to have more volatility and tend to not have as much assurance that we're going to get a return, or we could even lose value again over time. So the things on this screen right now would mainly be things that you'd be holding in that growth bucket. You'll notice gold, for example, actually lost value this year. Sometimes people think of gold as being some kind of a safe investment, where it always makes money, or, if stocks go down, gold has to go up. That's not always the case. So it's important to recognize that any kind of a commodity, which would include gold, I'd throw gold into a commodity as well. But any kind of a commodity can see huge price swings and actually have far more risk than other types of traditional investments like stocks. So these would be all examples of where that growth bucket money would have gone. Again, first half of the year, not a lot that we would have seen out of that. And again, somebody who's properly diversified and had international stocks probably lost some money on those temporarily. The other reason why you want to hold some international in your portfolio is that historically, if we look over decades, you actually ended up with less volatility, less turbulence by holding a portion of your investments in international stocks, typically up to 20-25%. And the rest in U.S. types of investments, that actually experienced lower volatility than somebody who just put 100% of their money in only U.S. stocks. So, tax reform, that was a big thing, obviously, going on almost a year ago. That was being debated, talked about, and finally passed by Congress and signed by the president in December of last year. That was a huge boost for corporate earnings. It helped individuals in some circumstances. And I can tell you, there were a lot of disappointed people, in the individual rates, because it was sold as a tax bill. It was the Tax Reform Act. But in a lot of cases, some individuals ended up paying more in income taxes because of the tax bill, especially depending on what state they lived in. For example, if they lived in a high tax state like California, Illinois, New York, New Jersey, Connecticut, those are all really high tax states for a state income tax. And it used to be that you could write off all of those taxes. And the bill actually, one of the things that it did is it capped that deduction amount up to $10,000. And so a lot of people even in the middle class, we're not just talking about wealthy people, a lot of people in the middle class were impacted by that. So it really depends on your exact situation. We can't just paint it as one where everybody made money because of the tax bill. However, corporations, C Corps specifically, which would be your big companies, your Apples and Facebooks and Walmarts, many larger companies typically have 100 or more employees, would tend to be a C Corp. And there was a huge decrease in the income tax rate for those corporations from 35% down to 21%. And we're seeing that now throughout this year. We're seeing great earnings growth. So that's a large part of that is fueled by the taxes, the tax cuts, and also just a lot of productivity gain. A lot of companies are doing very, very well. And again, part of those earnings, the earnings growth is because of not having to pay as much taxes. So again, earnings growth strong, depends on the sector. Obviously, you see this massive gain in earnings growth in energy, and I can tell you that that's just because it was coming off of such low levels before we finally seen a bounce back in energy prices and natural gas and oil prices, and that's boosted up earnings considerably from energy companies, the energy sector. But again, if you just look at the S&P 500 there in the middle, about 5 over from the left, S&P 500, 24%, and that's an acceleration of earnings. Again, a lot of that is because of the tax bill that passed and the reduction in the corporate income tax rate. So earnings are growing at a very good clip. So why didn't share prices increase? Well, at the end of the day, I would say it's largely because of uncertainty. The market doesn't like uncertainty, and what that does is it tends to keep people on the sidelines. Where are the uncertainties right now? Well, there's a lot of them, of course, and we'll talk about that here in just a bit. One of the benefits, though, of prices not going up much, but earnings going up a lot, clearly, is that it's made stocks look cheaper. And that's one of the things that you also want to watch out for as an investor long term, is that you don't get caught in a bubble. In a bubble, it could happen in an individual stock or a sector, or maybe even in the overall market. A classic example of that would have been in the late 90s and 2000 is that we had a stock market bubble. Valuations of stocks got way out of hand. Basically, it meant that stock prices were going up way faster than what the earnings of those companies were. And eventually, that's a problem because it means that people are really overpaying for what they've got. Obviously, that could happen with a lot of things. We can buy stuff, we could buy houses, we could buy stocks, all things that would be overvalued. And of course, that's a big problem if you are looking to sell those investments and you ended up buying in a bubble. Then that's a big problem, clearly, because now you're going to have to go out and try to sell it at a discount, sell it at a lower price if those prices have come back to normal. Now, normal would be that dotted line in the middle. So it kind of shows you where the average price to earnings ratio of the market is. Again, that's a fancy financial advisor ratio, but it basically just tries to give us a comparison point between are stocks expensive or are they cheap. So if you kind of look at where we are right now, the line actually shows we've kind of popped back down to a 5-year average. And who knows, maybe even we'll approach a 10-year average if we continue to see prices stay at a slow growth rate or even a decline here because of uncertainties about politics or trade wars or things like that. You might actually see stocks get closer to a 10-year, or more of a historical average. Means that you're getting a better deal for what you're buying. If you're buying new stocks, clearly it's better to stay out of bubble territory in any particular area because it probably means that you're looking at some downside, looking at some losses in those areas when those bubbles deflate. So yields on 10-year treasuries went up. Again, interest rates have been going up, and I think that's not a bad thing necessarily. Obviously, it's a vote of confidence, I think, in a lot of ways from the Fed and from individuals that really the economy it's real growth. The economy really is growing in a fairly healthy place right now, or it wouldn't be safe to raise interest rates up to more normal levels. So I think that's a vote of confidence from the Fed and again from investors, because ultimately the bond market's controlled by investors, not by the Fed. It's only short-term rates that the Fed can influence. So they're increasing what's called the federal funds rate, which is a short-term rate, versus the bond market is largely just people, organizations, governments that are buying and selling bonds. And that's what changes the yields and can change interest rates on longer-term things like mortgages, for example. And then again, I mentioned a sell-off in emerging markets. So again, more risk there, number one. So if people are looking to take risk off the table, that's one area that they'll often do it because those areas are so much more volatile. And the other part is just that the U.S. economy is doing well. It's a better bet right now. At least that's what investors are thinking right now, is that the U.S. is a better bet. And that our economy is so healthy right now in the U.S. that it really is a better place to invest than in international markets, especially emerging markets. So where we are now And again, I'll throw it out. We've got a chat feature and a questions feature. I haven't seen any yet, but feel free to compile those there. There's stuff that you want me to spend time on or to go over. But as we plug away here, I think we'll answer a lot of questions that I'm hearing, at least from investors. In the end, again, people are just trying to alleviate their fears. They're trying to alleviate the financial stress, which, if you think about it, where does financial stress come from? Well, sometimes it's individual based. Sometimes it's just in individual circumstances of what's going on in your life or your job or maybe your community. But the other side of it, though, is the media. And I would strongly encourage you to stay educated. That's always a good thing, to understand what's going on in the world and understand, kind of what might be impacting your money and your family and so forth. But also recognize that you maybe should have some healthy skepticism about the media, because if you think about what their job is to do one thing. And Mark Zuckerberg said it before, to sell ads. That's their job. That's how they make money, is to sell ads. And the way they would be able to have higher prices on those ads is to have more people viewing or reading or whatever it is that medium was. Well, how would you do that? So do you think you would get a lot more people to tune in by reporting happy news and, that, hey, things are just okay and, nothing to worry about? Well, no, of course not, right? I mean, people, even though that's good news, people don't tend to do it. Maybe that's a commentary on us as individuals, but the average, the ratio of all media in the U.S. is 17-1 negative to positive. In other words, there's 17 negative news stories for every one positive news story. And maybe I'm an over optimist, but I just don't believe that that's true. I don't believe that there are 17 times more bad things happening in the world than good things. So one thing to keep in mind is that as you're consuming media, remember what their mission is, what their job is. So if you're seeing a lot of negative news stories, that's one thing to keep in mind, is that, okay, well, why are we seeing so many negative news stories? Maybe it's not necessarily that things are so bad. And then the second thing is understanding on your own psychology, understanding that might translate, if you're consuming too much negative stuff, that might actually translate into decisions. And decisions are what are going to shape your destiny over time, your financial destiny, your personal destiny. So all of us, I think, should have a healthy skepticism. We need to be our own guardian at the gate of our minds and be careful about what we're consuming. In the U.S., we tend to be relatively happy, as you can see on the slide here. And there's different factors for that, of course. But in the U.S., things are actually pretty darn good right now. Most people that want to be employed are employed. And that translates, in most circumstances, that translates into some happiness, at least short-term happiness. We do know, by the way, that there's a number of studies about happiness and money, and that once household income goes over about $75,000 per year, it doesn't drive any more happiness. In other words, people don't say, well, I'm happier now that I make $80,000 or $100,000 or whatever that might be, because all their basic needs at that point are basically met. So if we think of it from a financial security standpoint, the average person in the U.S. basically has kind of said, hey, we need about $75,000 in the household to feel financially secure, to put food on the table, to provide shelter, to provide health care, the basics of what somebody would need. Beyond that, then it's probably things and stuff and vacations and things like that, which are not a bad thing necessarily, but probably not going to drive any more actual happiness. Happiness comes from within ultimately, and when people feel fulfilled and that they're growing and contributing, that's where that longer term happiness comes, after people feel financially secure. So productivity is improving across the globe, most countries anyway. You can see, for anybody who's a geography buff, you can see the darkest green thing on the map actually is Libya, and they're growing at a 10% or more clip right now. Don't worry, we don't have any of your investments in Libya right now. It's not a big focus for us, but you can see that most economies right now are seeing productivity growth. And certainly in your more industrialized nations, probably not as fast as others. Some of our emerging markets, for example, productivity is growing faster than in some other areas. And again, that's a big driver as far as growth. Geopolitical risks. So, this kind of comes down to, well, what could go wrong with this? What are the things that could happen that would end the party that we've been in for quite some time? I think we actually might have, within the last few days, or maybe we'll hit it in the next few days, the longest running bull market in history. U.S. stock market history. So naturally, sometimes that drives a little bit of fear with people in that, well, what's going to happen? Really, is the party going to be over because we've hit this record? And gosh, I remember what happened. People will say, oh, I remember what happened before, the financial crisis or the 80s or whatever it was. People tend to have, especially with big economic or financial events, tends to be pretty formative with people's values, and they might be making decisions based off of that in the future. So some of the things that could happen, this is not here to scare everybody, but certainly anything that's on this chart is something that could happen. There's also a lot of things that aren't on this chart that could happen. And when uncertainty goes way up, the stock market tends to get very volatile. And people don't like uncertainty. People like to kind of know what's going on. And unfortunately, that's not the way the world works, right? So there's a lot of unpredictable stuff. And so a couple of things that we're watching right now certainly are trade. That's been in the financial headlines a lot as far as tariffs, and it doesn't seem to have impacted at least the U.S. market a lot up until now. But trade wars, if a full-fledged trade war started between us and China or us and Europe, certainly that could cause some problems. That certainly could cause a lot of uncertainty in the world market. We'll get into that in a little bit. But also, thinking about conflict, there's a number of areas in the world, and there always are, but there's a number of areas that if we got into any kind of a conflict or other countries got into a conflict, whether it's North Korea or China, certainly that would add a lot of uncertainty, a lot of fear into the market, and would drive certainly prices down, I think, for a while. So, obviously we can kind of play with the odds of certain things happening, but right now trade seems to be the one that's on most people's minds. But again, the market's largely ignoring it. We're still seeing growth in the U.S. at least. Other markets, for example, China's markets are way off right now. They've sold way off. One thing that we actually do have going for us is that the U.S. actually is more self-sufficient than many other economies. In other words, we can do a lot of trade within, and it doesn't impact us as much maybe as some others versus some countries like China, for example, that basically they export like crazy. We don't export as much, so it's not something that's going to impact us as much as some of these other countries. So they could negatively affect us, certainly. Certain industries, for example, could get hit pretty hard. Right now, steel, seems to be the biggest thing out there, and there's certain states that tend to be more impacted by that than others. And again, if it turned into a full-fledged trade war, which I certainly wouldn't say that we're in right now, but a lot of people are kind of looking back to the 30s and saying, well, there was a trade war back in the 30s, and that largely is to blame for why the market went down, the economy got so bad, and we went into a depression for so long. Also, some mismanagement by the Federal Reserve at the time, certainly. But trade was certainly a factor back in the 30s, and that's a fear certainly from some people. But the tariffs that are being imposed right now are way less than what they were back in the 30s, and I don't think there are any winners in a trade war. In the end, everybody gets hurt, and so there's definitely an incentive for everybody to come to the table and come to an agreement. The problem is that everybody gets impacted. It's not something that we can say, well, it's just the U.S. or it's just Russia or just China, because pretty much any kind of a complex product these days gets manufactured with parts from all over the world. And you can see Boeing aircraft here, for example. You can take a look at the different countries and the different areas in the U.S. that you'd find all the parts from it. So everybody gets impacted and everybody loses if we see an all-out trade war. And you can see on our chart here different things. There's different supply chain, different ingredients and parts and things like that. And some things are impacted more than others. So you can see the kind of the conglomeration here and whether we're able to source those things from other countries besides China. They do hold a lot of our treasury bonds. Another fear that I'm hearing a lot of people say is, well, what if China were just to dump all our bonds, all the treasuries that they own, since they have so much of our government portfolio right now? And I can tell you that they could. Certainly that would be an option, but they would actually get hurt just as bad as we would. So in the end, that would not be good for China. The U.S. is still the world's reserve currency. We are right now, and I know there's talk about Bitcoin and some cryptocurrency long term maybe having an impact on this. But right now, clearly the U.S. is the world's reserve currency. There's no economy or currency that even comes close as far as the stability and the backing as far as another economy. For example, you could point to other smaller countries like Canada or something like that and say, well, a Canadian dollar, maybe that would replace the US dollar. They're just not big enough. They're not a big enough economy for them to take over as a currency. And certainly with the problems Europe has had, that's not one that I think many people trust. Look at China. Obviously, they're still a communist nation. Technically, they've embraced a lot of capitalism, but if you look at the country, it's not one that I think most people would trust to put their money. So, therefore, the U.S. still is likely to be the world's reserve currency, and China really needs us as much as we need them. So investors are fairly bullish. I think this is very important to look at. So pay attention. Everybody sit up in their chairs because this is something that would impact you directly. The average investor over time, this isn't actually on the slide, but the average investor over time does very, very poorly in the market. And that's because they buy when they should be selling and sell when they should be buying. The reason why is they get emotionally wrapped up in what's going on and they panic or they get greedy. And that drives decisions that really are not in that person's best interest. And of course, we all say, well, we would never do that. But, well, maybe we're all not average, but the average American tends to buy high and sell low. And they do it consistently over and over and over. A lot of buying that's happening right now because of the great economy, the great market that we've been in, and that we're used to not losing money on stocks here for a while. But I can tell you that party is going to end at some point. We are going to have winter come, and that's the point where it's very, very important to have that person have their asset allocation correct. In other words, we want to make sure that we're prepared for it ahead of time so we're invested the right way for that particular investor. So when winter comes, we've already prepared and we've got investments split up between those security and growth buckets that are appropriate for that person. Otherwise, what ends up happening if the asset allocation is not right, then what ends up happening is that people tend to have way too much risk in their portfolio for what they're comfortable with. I can tell you this from experience too. This isn't just theory. I've been through two of the worst bear markets in history. That would be the financial crisis from 08 and 09, and looking back to 2000 to 2002 with the dot-com bubble and 9/11 and corporate accounting scandals in 2002. The same thing happens over and over again, is that people take on too much risk when they should be more conservative because that's really what they're fundamentally comfortable with. But if they get too risky, then their investments tank when things go bad. And what do? They panic because they're not comfortable and they sell, and then they sell low. And then they're sitting in cash or bonds or something like that. And then when do they get back into the market? They wait until things get better, but of course then prices are high. And so you get on this crazy cycle. Of course, you wouldn't do that, right? And that's our job, basically, to make sure that investors aren't behaving that way and making sure that we get that fundamental decision right from the beginning and that we've got people's investments allocated correctly. So, point of this slide is to show you that as of the end of June, there weren't a lot of bullish investors because of the correction we had earlier in the year. And all the volatility, it tended to create a lot of fear in the market. And so there weren't many people that were bullish in June. And actually, there were more bearish people in June. But what happened in the market in July and August here? The market went up. We saw all kinds of gains in the market now. And what that tells you is that the average person, and the source here is the American Association of Individual Investors, that the average investor does exactly the opposite of what they should be doing. They're buying when they should be selling and selling when they should be buying. And the answer is really not either one of those things. The answer is that there shouldn't be any timing required for a long-term investor. What it's all about is that asset allocation decision, making sure that we've got the right ratios for that particular person so they can get through any kind of a market, whether it's good, bad, sideways. We want to make sure that they've got a strategy and a plan so they can get through it without doing anything crazy and blowing up their portfolio. So where we may be going, and a little bit more fun for those of you movie buffs, which of these movie characters said, "You're going to need a bigger boat"? That one's a little bit older. We've got Sheriff Brody from Jaws. Second one, which of these movie characters said, "Happiness can be found even in the darkest of times if one only remembers to turn on the light"? This one's a little bit newer. It's Professor Dumbledore from Harry Potter. And which of these movie characters said, "Don't you see what's happening? Potter isn't selling, Potter's buying." And why? Because we're panicking, and he's not. That's why. He's picking up on some bargains. And that's a really old one, but that goes back to It's a Wonderful Life. It's my favorite Christmas movie. But the quote here from George Bailey is really important because it was talking about what I was here a couple of slides ago, in that you don't want to be buying when you want to be buying when everybody else is selling and selling when everybody else is buying. You want to be kind of contrarian in the sense that if you had to time the market, and I don't recommend you do, but if you had to time the market, you'd actually get more conservative when everybody else is more aggressive and vice versa, because when everything is expensive and people aren't perceiving any risk in the market, that's actually when the biggest risk is there, because prices are very high at that point. So I'm not trying to make a judgment on where the market's going right now, but the whole point, though, is you have to have kind of reverse psychology with investing. In other words, what you're going to want to do naturally is get greedy or get fearful at the wrong times. So where are we? I'm going to spend a few minutes on this slide because I think it's important to think about what season we're in. Back to what I mentioned before, and that you've got the 4 seasons throughout the year. You could kind of translate that into the 4 things on the screen. The early would be like the spring, and the mid would be like the summer, and the late would be like the fall, and then the recession, that's winter time, right? So if we think of these like seasons, kind of look at the descriptions here for a second. I'm going to leave this up for a moment so you can read through the descriptions of the different seasons, and you might have your own judgment on where you think that we are. And this is politics aside. You might have your own judgment on where you think we are, and you might think that we're still early. You might think that no, we're way late in the game, and we're about to see a big dry up in activity, and things really unwind here in the next year or two. So important to think about, what this is for you. You can have your own opinion. I will give you my opinion, and that is that we are probably in that mid stage right now. So I think we still have some room to go until things tank. Bernanke, so when I heard him speak in February, he talked about 2019 and 2018 or 2019 actually being pretty good still, largely due to productivity gains, largely due to reduction in cost, from taxes, with corporate income taxes going down. That's added a lot of stimulus into the market. And things get a little bit hairier to 2020 and beyond. It's a little bit too far out to predict. That doesn't necessarily mean that everything just, blows up in 2020. That we could have a slowdown. We could even have a minor correction, bear market, recession. Those are fairly routine historically. So it's possible that would happen, and we would end up not having a complete blow up, but we could. It's one of those things that the Fed's job is to kind of unwind things as slowly as they can, and if things get really bad again, then they start to loosen things up. Congress, obviously, there's other factors in the government and the economy that can impact things, but we're probably in that mid, maybe even to late stage right now. We still have some room to go, in my opinion. So inflation is starting to tick up again, largely, I think, due to the fact that wage growth is happening. And a lot of people are applauding that. They're saying that's great. People are getting increases on their benefits and on their pay. So it's okay. We're seeing inflation climb back up to more normal levels. More normal levels actually are up in the 3.5% to the 3.8% range historically. So inflation where we're at right now actually is pretty darn low compared to that. Expect interest rates to move higher because of that. Inflation really is fairly mute right now, but the Fed wants to keep it that way. And again, the economy is growing fast enough that they think that the economy can take it. Basically, we're healthy enough right now that it can absorb interest rate increases, and it's actually healthier to have more rates at more normal levels than to keep them so artificially low. Where we see things going on the rest of the year, my guess is 2 more rate increases in September and December. So that's very likely. I think at this point, unless there's some kind of a shock event, you're going to see a couple more quarter-point rate increases. Next year, 3 or 4 rate increases are likely. Again, if things continue to click along, that's very likely to happen. So rates are going higher, and inflation probably is going to stay in check. Now, I'm not reading very much from experts right now about hyperinflation, but that's always possible. There's always a possibility that inflation would get out of hand. Hopefully, the Fed is skilled enough that they're able to continue to raise rates and tighten things up so we don't get to that point. So global monetary policy, kind of the same thing globally. Most of the world's economies are actually tightening right now. The more industrialized nations are tightening, but not to a large extent. It's not extremely out there on the scale. When you look at the far end of the blue, that means very loose policy, and then on the other end, it's very, very tight. Right now, most Federal Reserve and their equivalent around the world are actually tightening on a net basis. Kind of telling the same story here. You look at the different countries throughout the world, and ultimately slower growth ahead. So there's a few different opinions here I'm going to throw out from different economists. One here is that real GDP growth has trended lower over the last 50 years, and basically just the economy, especially in the U.S., is probably not going to grow as fast in the future. That the GDP growth we're experiencing right now, up in the 3s and 4s, probably is not going to continue at these levels. A large portion of that, by the way, I think really is just the fact that government spending is so high, and really neither party has done anything to try to contain spending. So that's one of those things that if the government spending is high, it's actually going to cause problems with the economy and the market in the future. If you get too out of hand, certainly we've seen examples like Southern European countries that actually go insolvent. Obviously, we're nowhere near that at this point, but it does tend to result in slower economic growth. So, and Ben Bernanke again, he said in 2020, Wile E. Coyote is going to go off the cliff. Everybody remembers Wile E. Coyote, right? I always enjoyed the Looney Tunes cartoons, and he gets hit by the anvil, of course, or something really strong, a big rock or something like that. But at the end of the day, really right now, because of the stimulus that's been pumped in, we probably have some room to go here. We probably still have an economy that's going to continue growing for some time, and that the market will continue to see some level of growth. My prediction, by the way, in January, again, just my opinion, but I expected that we would see a total return in the S&P 500 of 10 to 15%. We're on track to do that right now, so we'll see what happens by the remainder of the year. But certainly with earnings growing up in the 24% before, and market growth at 10 to 15%, that's not out of the realm of possibility, considering that stocks are not particularly expensive right now. They're also not particularly cheap, but they're not way out of whack like they were back in the late 90s. And then finally, just a cautionary tale again. Jenny Johnson from Franklin Templeton Investments says when money just goes irrationally into stocks without some fundamental review, we think there is risk. Like I mentioned before, when people don't perceive that there's risk, there actually is the highest level of risk with regard to markets, real estate, anything like that. There's always risk in every sector. Every sector is going to experience a downturn eventually. Very important to make sure that your portfolio is risk adjusted. That means that we don't just look at the returns. We look at how much risk is being taken to get those returns. And also going back and just looking at what kind of return do I need? What return do I need to make my plan work? And for a lot of people, they don't want to take any more risk than they have to get that return. So it's important to look at where you are individually. So ultimately, it's about planning. It's about your life. And again, I'll open it up for questions here at the end. But ultimately, financial planning and investment management is all about individuals. It's about your life, your preferences, all the things that you've got going on and that you've done over time and that you want to do in the future. That's really our job, is to take the worry out of all this and really to reduce that as much as possible. Because I think fundamentally, if you boil down really what good is a financial advisor or a financial planner, why do people pay them? Ultimately, I think it comes down to that. The people don't want to worry about their money. People want a sense of financial security, and they see that sense of financial security by having an expert that not only has the book knowledge, and they've gone back and looked at experts and everything and the right strategies, but also they've got practical knowledge. And my team and I have been around a while here, and we've been through some tough markets. So it's important to look at not only the academic side, but it's also important to look at experience and really what works and what doesn't in different types of markets. We've got a few things coming up. We've got the Love and Corn Roast actually is tomorrow night, so this is coming up really soon. We've got a corn shucking team, so if you're going to be stopping by there, come cheer us on. I think we start about 5:30 or so Mountain Time. We've also got our Thanksgiving Client Pie event, and that's just a thank you event and always kind of a fun family event to have people stop by. If you're a client of Keystone Financials, certainly we'll welcome you in, and you can enjoy some Thanksgiving pie and some other treats and things like that. So always a good time. And then Toys for Tots, we've got later on this year. We've supported Toys for Tots for a number of years now. That's one of the things that really is a core value of Keystone, is that we want to give back. We really want to make sure that we've got some things that we can be passionate about helping people and helping people that are less fortunate than we are and our clients are. That's one thing that, we're all, I think, really, really blessed to be where we are and have the financial resources that we have. So we do want to support organizations that we can get excited about and that we know have an impact on people. So Toys for Tots, we're doing an event. If you drop by a toy, and if you're not in the area, you could actually just ship it to us. If you want, use Amazon, ship it to the office, and we'll make sure that Toys for Tots gets the gifts. They turn those around and they give them out to local kids, and really, really neat organization that the Marines have sponsored for years and years. So we do partner with them, and want to invite you to be able to partner with us in helping put a smile on a kid's face at Christmas time. So with that being said, here's our team. We're all excited to be able to work with you and continue working with you. I'll put up my webcam again. So really at the end of the day, it's about people, it's about relationships. If you think about, again, the core of our business, it's about the relationship with the client, what they need, building that relationship so we really understand what you need and what your family needs, so you can really live the life that you want to, and hopefully not have to worry about your money so much with life. You probably have a lot going on besides your money. That's why I've found over the years that if people don't use an advisor, somebody who's experienced and is good at what they do, what tends to happen is that people either do one or two things. Either they are really, really stressed out because they're always worried about their money, or number two, they ignore stuff because they're busy. They've got a career, they've got a family, they've got activities and things that they're taking care of. And so the finances kind of get ignored. They really don't get looked at like they should. And there's a lot of decisions along the way that could have been made better, with the help of an experienced expert. So that being said, I'll open it up for questions. I don't see any yet. Hopefully that means I answered all of them so well that I don't need to answer any right now. But as we're wrapping up here, certainly think about what I said before, in that kind of the four top things that I think are important to look at. Look at inflation, look at interest rates, look at GDP growth, and look at earnings, because ultimately it's those four things, I think, as far as when you go for a physical, for example, you kind of get a health report at the end as far as how you're doing. I think those four are probably the core four that I look at to see really how are things right now. How is the economy? How's the market? I mean, obviously, there are a lot of other factors where we try to guess. We try to figure out where do we see things going in the future. But ultimately, it really does come down to that one most important investment decision for you individually, and that's to make sure that your asset allocation is right. Again, with those two buckets, if I could hold two buckets here, I should get two buckets so I've got a visual aid, right? But if I had two buckets, everybody's going to have those two buckets to one degree or another. Based on where you are, it's important to think about what risk levels are appropriate. In other words, how much loss you can take before you get really stressed and lose sleep at night. So it's our job to help you measure that, help you figure out what that means to you. So, but also not ignoring the growth bucket, because most of us don't have gazillions of dollars where we could just throw it all in the bank and not earn any interest and not have it grow over time. So it's figuring out, it's our job with you, is to figure out what the ratio should be between the two buckets, and then what's in the buckets. What are the different investment vehicles and things. And of course, we have a fun time doing that. And if you have any questions at all, certainly holler at us. I don't see any questions in the queue, so I'm going to let it go for today. I know a lot of you will watch this on a recorded version, so please reach out to me if anything pops up in your mind that is stressing you out, you just have questions on, you might be confused about. My email address is josh@keystonefinancial.org. And again, you can go to our website, www.keystonefinancial.org. Final thing, we do have a handout, and the handout actually is in the handouts folder of the webinar browser. So go in there. That actually does give you the key financial data for 2018. We put that out every year, and that does have all the new tax brackets, all the updates for how much money you can put into your 401k and how much of your Social Security gets taxed, those sorts of things. It's a very helpful resource. So I highly recommend that you print that out or save it to your desktop So it helps you for your planning throughout the year. And of course, we'd be honored to be able to help you with that. Again, if you're not working with us right now, we would love to be able to sit down and see if we could improve, develop, or change your financial situation. I think that we're really well positioned right now because of all the resources and the team that we've got to be able to help anybody that needs that. If you're an existing client, thank you for your business. And again, the door is open. So please reach out if there's anything that you need. And we're honored to be able to help any friends or family that you point our way. Have a great day. You guys enjoy your weekend, and God bless. Take care.